Hello, Team 201. Our next installment in our journey through the conceptual framework is looking at the chapter on measurements. The name is pretty self-explanatory, but let's put it into the context of what we've been doing so far. So the whole point of the framework is providing useful information to users of your financial statements. And to make that information useful, remember, we need to look at the qualitative characteristics. And then all the decisions we make in that whole process needs to be useful. So it's about everything from what is the reporting entity we're reporting on to identifying the elements. And we began with this general journal entry here where we said, right, we do have elements, so we can put them on a blank piece of paper. We meet the recognition criteria, so we can do the journal. We can bring it into the accounting records at the debit and credit. And the next step we're looking at is at what amount can we bring those in? And again, it's going to be about bringing it in at amounts that are useful to the users. So you're going to see those qualitative characteristics coming through again very strongly in this section. So the first is cost measurement base that we'll be looking at is historical cost measurement. This one you should be fairly familiar with. You would have, if you started accounting at school, already seen it there. It's probably the oldest and the most traditional form. Some people view this as the most reliable form of measurement because it doesn't really involve many estimates. It's something that was paid back at a point of time many years ago, perhaps if it was buying a property. But because of that, if you think about property I purchased 20 years ago, if I'm carrying that property in my accounting records at that historical cost, when the property market has moved so much in 20 years, that's when you start wondering about things like faithful representation. Are we faithfully representing what their property is worth to us if we choose to have it in there at a cost model? So there you're already seeing now very early in our discussion how I've gone back to those qualitative characteristics of useful information. But this is a measurement base that is in accounting, and it's the oldest one that we're working with. The next measurement base that's listed in the standard is this current value measurement base. And the two characteristics to watch out for there, or the two subcategories, if you like, is a measurement base that is externally priced and something that's more internally priced and entity specific. Now, what do I mean with that? Well, entity specific is something when I have an item, an asset of whatever nature, perhaps inventory, and that inventory, I determine the selling price that it's going to go out into the market at. That selling price may differ from all my competitors for whatever reason. It's unique to me. It's my entity-specific value. So in some instances, in some of the standards, you're going to see that they use this entity-specific value. Then you're going to have other ones that are not entity-specific, but more concerned with what the market value is. And that's things like your fair value, where you would consider what price is generally asked in the market. So with your current values, it's either the entity-specific one or one that considers more broadly the market. And how do you choose between these again? Well, it comes down to, are you able to faithfully represent this amount? Does using whichever base more faithfully represents it than another measurement base? And is it giving relevant information to the users of your financial reports? So we've briefly touched on a couple of measurement bases, and there's a lot of detail on the framework, and please spend some time going through it, read through the thinking and how the board would apply this and how they would consider something to be relevant or faithfully represented. But I need to, at this point, just pause and say that this is a new chapter in the framework. It wasn't in the 2010 framework. It wasn't in the 1989 framework. And that's caused a lot of difficulty in IFRS because our measurement is really everywhere. So when you're reading standards, remember what we said early doors in these videos is that you need to consider when the standard was set to which framework you're applying. So going forward, when the ISB is setting measurement bases as a new standards or revising existing standards, they will work from this base, and that's going to help us. But you're going to need to rely quite heavily, I think, on your instructors and maybe students that have already been through the program, if you consult with them, to help you understand why a particular measurement base might have been chosen. But you almost need to put yourself in a bit of a time machine and get information together to try and understand the thinking. So if I can just give you a bit of advice, generally people in measurement falls into one of two schools. And the one is the space cadets and the other one is the dinosaurs. So what I want you to remember is the dinosaurs is generally older standards, and they favor historical costs because they were very conservative. That's the time when prudence was very dominant towards being negative, which is not what is the intention these days. So that conservative era would rather measure it accurately and leave the land and buildings, for example, at their historical cost. At least they know that number's right. If you've moved into the space cadets into measurement now in the 21st century, you probably start favoring fair value because although it might not be perfectly accurate, it more faithfully represents what your property, for example, is worth now. But it's different schools of thought, and you need to also decide now, as part of your growth as an accountant, what school do you fall in? There's no right or wrong answer. Remember that, please. Your opinion is valid, whatever it is. So you need to decide which one do you think is better for financial reporting. And going forward in the standard setting process, when you can contribute your opinion, because that diversity gives us good argument, good debate, and gets us to more rigorous standards that we can apply in the world of financial reporting. So just coming back to this again now, I've said to you that if you want to understand a standard, go back to when it was written. So most of the standards at the moment, you need to, for measurement, go all the way back to the 1989 framework, and it sucks. To be honest, there's not much about measurements in there. They list a few things, but no help. The 2010 framework, though, is giving you these qualitative characteristics or reminding you of them and saying, when you choose a measurement base, please consider, can you give relevant information? There's a few factors to consider. And can you give faithfully represented information? And this is where you really come down to those things of measurement, inconsistency, and uncertainty. Is there uncertainties available? Can you make a good estimate of it? Can you get somebody to help you make a good estimate? Or other people doing similar things that you can have comparable financial statements in an industry? Because you don't want your investors to be battling to work out what your entity is really worth against another one. That sort of defeats the whole purpose of having an effective financial market. And then again, the cost constraint to be familiar with at the bottom there, we've discussed that previously. Pretty much that's up to the ISB to decide. They don't really want to let preparers use that exception, as we've discussed previously in another video.